In 2014, Mt. Gox, at the time the world's largest Bitcoin exchange, collapsed after losing approximately 850,000 Bitcoin. At today's prices, that represents over $50 billion. The cause was not a sophisticated hack in the conventional sense. It was catastrophic key management failure. The private keys controlling customer funds were inadequately secured, and attackers exploited that over an extended period. This is the central lesson of crypto custody. Unlike traditional financial assets, digital assets are secured by cryptographic keys. Whoever controls the keys controls the assets. There is no SIP insurance, no FDIC backing, and no central authority to reverse an unauthorized transfer. For institutional investors, this is not a reason to avoid the asset class. It is a reason to understand custody infrastructure with the same rigor applied to any mission-critical operational risk. This video is your foundation. A crypto wallet is fundamentally misnamed. It does not store assets in the way a physical wallet stores cash. The assets exist on the blockchain, a distributed, globally replicated ledger maintained by thousands of nodes. The wallet stores the private key, a cryptographic secret that authorizes the owner to move those assets. Understanding this distinction is essential for institutional risk assessment. Three components work together. The public key is your network address, mathematically derived from the private key but impossible to reverse engineer back to it. You can share your public address freely. It is analogous to an account number. The private key is the secret. It is a 256-bit number, typically represented as a 12 or 24-word seed phrase. Anyone who possesses this key controls the associated assets completely and irrevocably. No password reset, no customer service call, no court order can recover assets sent from a compromised private key. Third, the blockchain itself is the ledger of record, permanent, immutable, and globally visible. Custody exists on a spectrum from maximum convenience to maximum security. At the hot end, exchange wallets, such as holding assets directly on Coinbase or Binance, provide the easiest access but leave the investor exposed to exchange counterparty risk. The exchange holds the private keys. You hold a contractual claim. This is appropriate for active traders, not for institutional treasuries. Software wallets on internet-connected devices reduce exchange counterparty risk but introduce device compromise risk. Hardware wallets, physical USB devices like Ledger or Trezor, store private keys in an offline environment, eliminating remote hack vectors. These are suitable for individuals but lack the governance controls required for institutional mandates. Multi-signature cold storage requires multiple independent private keys to authorize any transaction, typically a 2 of 3 or 3 of 5 arrangement, providing institutional-grade separation of duties. Finally, multi-party computation, or MPC custody, distributes cryptographic key shares across multiple secure environments such that no single party ever holds a complete key. This is the current institutional standard, used by Coinbase Prime, BitGo, and Anchorage. When evaluating a crypto custodian for an institutional mandate, 4 due diligence steps are non-negotiable. Step 1. Confirm regulatory status. In the United States, qualified custodians for crypto include entities with a New York BIT license, a South Dakota trust charter, or equivalent state-level trust company status. Investment advisors regulated under the SEC custody rule must use qualified custodians. Verify the designation is real and current. Step 2. Review insurance. Unlike SIP coverage for securities, crypto custody insurance is privately arranged. Coinbase Custody maintains over $320 million in cold storage coverage through Lloyd's of London syndicates. Understand the policy triggers, exclusions, and whether hot wallet balances are covered separately. Step 3. Examine key management architecture. Request technical documentation. MPC custody should be able to demonstrate geographic distribution of key shares across jurisdictions. Step 4. Require SOC 2 Type 2 report. This demonstrates that the custodian's security controls were independently tested over a 12-month operating period, not just reviewed in design. 2 dominant names in U.S. institutional crypto custody are Coinbase Prime and BitGo, each with distinct strengths. Coinbase Prime combines qualified custody with full prime brokerage infrastructure, trading, OTC execution, staking, and reporting all integrated on a single platform. It holds over $100 billion in assets under custody, maintains a New York trust charter and BIT license, and offers MPC-based key management with hardware security modules. Its primary advantage is breadth of service for institutions that want a one-stop platform. bitgo pioneered multi-signature custody and remains the specialist in that architecture. It operates under a South Dakota Trust Charter and BaFin regulation in Germany, covering European mandates. bitgo's 2 of 3 multi-signature system provides transparent, auditable key control that some institutions prefer for its predictability over MPC's more complex cryptography. Both custodians carry institutional-grade insurance and publish SOC 2 Type 2 reports. The choice often comes down to whether an institution prioritizes platform breadth, favoring Coinbase, or architectural transparency in key management, favoring bitgo. Even with a qualified, insured, SOC 2 audited custodian, 3 residual risks require explicit attention in institutional risk frameworks. First, smart contract risk and staking. When a custodian stakes your Ethereum, the assets are deployed to smart contracts on-chain. The custodian's key management is sound, but the underlying smart contract may contain vulnerabilities exploitable by attackers, independent of the custodian's security perimeter. Evaluate staking smart contract risk separately. Second, custodian insolvency. The FTX collapse in November 2022 was a severe reminder that client assets held with an exchange can become entangled in bankruptcy proceedings. True qualified custody, where client assets are held off the custodian's balance sheet in segregated accounts, provides meaningful but imperfect protection. Confirm segregation explicitly in your custody agreement. Third, operational irreversibility. A transaction to an incorrect address cannot be reversed. Institutional custodians implement address whitelisting. Only pre-approved destination addresses can receive withdrawals, and multi-approver workflows. Verify both controls are active and tested before going live. A 5-point custody checklist for institutional investors before any capital deployment. First, confirm qualified custodian status independently, not from the custodian's own website or pitch deck. Contact your legal counsel and verify with the relevant state regulator. Second, review the SOC 2 Type 2 report in full and read the actual insurance policy. Know the per-occurrence limits and the exclusions. Third, understand the key architecture. MPC and multi-SIG are both defensible. What matters is geographic segregation of key shares and the number of signatories required for withdrawal authorization. Fourth, get asset segregation confirmed in writing in your custody agreement. Client assets should be held in accounts clearly segregated from the custodian's proprietary assets. This is what separates a qualified custodian from an exchange. Fifth, before moving a single dollar of institutional capital to custody, activate address whitelisting and test the multi-approver withdrawal workflow end-to-end with a nominal amount. These 5 steps are not optional. They are the minimum standard for fiduciary compliance. Custody is where institutional crypto risk starts, and where it can end if done correctly. Crypto Mechanics covers every layer of digital asset infrastructure with the depth that portfolio managers and compliance officers need. Subscribe now for analysis that treats crypto with the seriousness it deserves in an institutional context.